Good morning, everyone. I'm Millie Hong, Head of Events at ASIFMA. Thank you very much for joining us today at this virtual event, The Souring of Asian Credit, COVID-19's Impact on Demand, Debt Repayment, and Market Liquidity. Let me introduce our host and moderator today, Mr. Mark Austin, CEO of ASIFMA. Mark, over to you, please.
Thank you very much, Millie, and a very good welcome to all of you that are joining. We're almost up to 200 participants on this webinar that we're doing today. I wanted to welcome all of you, and I also wanted to thank our endorsers that have been endorsing this event to help us get the message out to a wider audience, and that includes ASIFMA in Australia, IBA Japan in Japan, IMAS in Singapore, and AmCham. So thank you very much for your endorsement of this webinar today. So I'm quite excited, but before we get going with the panelists and I introduce them, just a few housekeeping notes for you. Before we begin, we wanted to cover how we kind of help you navigate through the virtual event. So for the best viewing experience, we recommend you use the full screen mode, and you can see that in the top right-hand corner if you're dialed in through the internet. If you have any questions, please use the Q&A box at the bottom with the little bubbles, and use that to ask questions, and I will direct those to the panel as we go through and also at the end. There will be some live polling. We have 2 polls that are going to be going on during this during the panel, and I'll direct you when to vote in those polls. In addition, this is recorded, so just for everybody's purposes, we are recording this live, and it will be put on our website for people to access from an on-demand point of view. So those are the basic housekeeping points that we wanted to raise. I'd now like to take the time to introduce the speakers. We've got a great lineup here today. First, I'd like to introduce Richard Cohen, who's Head of Primary and Credit Markets APAC for BNP Paribas, and Richard's also co-chair of our Fixed Income Steering Committee. Welcome, Richard. In addition, I'd like to introduce Cecilia Chan, who's the Fixed Income CIO for HSBC's Global Asset Management Group, as well as being very much engaged in our asset management group here at ASIFMA. And then in addition, I'd like to introduce you to Michael Taylor, Managing Director and Chief Credit Officer for APAC at Moody's, who also is a very engaged member in ASIFMA. So let me thank all of you, and I think we look forward to a really good panel. So maybe just to kind of set out some brief comments at the beginning, as you will have seen from the EDMs that have gone out, what we're really here to talk about today is the credit functions, so how the credit is functioning in the Asian markets. What we're going to discuss is what is the economic context for the recent downgrades in the Asian credit. How is the souring of Asia credit impacting liquidity in the local currency bond markets? And what is the impact of COVID-19 on the US dollar credit market here in Asia? In addition, we'll talk about, are there particular concerns around credit quality in China, Indian, ASEAN, and in the sovereign and corporate bonds. In addition, we'll also take a look at the default outlook for Asia over the next 12 to 18 months. And then finally, before opening up to questions, we'll talk about the emerging market credit landscape and how it's differing from some of the developed economies around the world. So that's what we plan to cover. And so before kicking off, I just wanted to remind all the speakers, you can put yourself on mute when you're not speaking if you want. And then just as a reminder to everybody who's participating, you can use the Q&A bubble to ask questions, and we'll either address those during the panel or we'll address them at the end. So without any further ado, why don't we kick off and with the first question on the economic context, and then also how that's impacting recent downgrades in Asia. And I'm going to turn over to Michael to kick off on that. So over to you, Michael. Thank you.
Well, thanks very much, Mark, and thanks to ASIFMA for organizing this event. And it's great to see so many participants. So clearly a lot of interest in this topic. as far as the economic background is concerned, we've been in a situation for the last few months, which an old friend of mine who's been in the forecasting business for a very long time said to me, seemed like perma forecasts. You were in perpetual revision mode, and certainly during March and April, pretty much every major forecaster from the IMF onwards was downgrading their growth forecasts for the global economy as the scale of the impact from the coronavirus outbreak started to become more apparent. Initially, of course, it was a shock that originated in China and impacted on China. And the way that the Chinese authorities dealt with that through the lockdowns had a major impact in terms of China's industrial production and also in the services sector. And we started to see the impact there in terms of Chinese growth. But then, of course, many of the economies in the region are now very heavily dependent on export demand from China. They export a lot to China now. In fact, it's a larger export destination for many of them than the US or the EU. So the slowdown in China did have a major impact on the rest of the region. And then, of course, the coronavirus spread globally. We started to see both supply disruptions as supply chains were disrupted, demand falling as the lockdowns were extended across quite a number of major economies, which had an impact in terms of demand, consumer demand, investment sentiment waning, and also then, of course, financial market volatility. So you add all those up, and it was a pretty major economic impact. So we were trying to track all of those different factors as the data came in and as we started to see the economies globally starting to slow down. So our latest forecast is for the G20, and we produce forecasts for the G20 economies. For the advanced economies in the G20, we're expecting growth to contract by, or the economies to contract by 5.8% this year. And even with a gradual recovery, we're not expecting a V-shaped recovery. It's going to be a gradual recovery. By the end of 2021, the real economic output, the real GDP in most advanced economies will be below the level it was at the end of 2019. So it's going to take at least until the end of 2021 for economies to recover to approximately the size that they were before the shock. For the emerging economies in the G20, the contraction is smaller, but it's still 3.5% down in 2020. That's below our forecast for the G20 emerging market countries of 3.2% growth, which we had before the coronavirus outbreak. So we've gone from +3 to -3.5. China's economy, we think, is going to grow by about 1% this year. That, of course, is a major reduction in terms of what we've become used to in the case of China. And quite notably today in his work report, in the MPC, Prime Minister Li indicated that there was not going to be a growth target for this year, which is, of course, a major change in terms of China's economic policy. So the economic outlook is pretty dismal. There are downside risks to that forecast, particularly if we started to see some of these lockdowns lasting for longer, or they need to be reimposed later on in the year because there are fresh outbreaks. I think if that kind of outturn happened, obviously the outcome would be much more negative. Now, in terms of default rates, just turning to Asia Pacific specifically, we've had default rates which have been very low in Asia Pacific over a fairly extended period of time. In 2019, the default was, the actual default rate was 1.1%. We have what we call the credit transition model, which forecasts the trailing 12-month corporate default rate for high yield corporates. And according to that model, we're expecting default rates to rise to 6.4% by the end of this year under our baseline scenario. And that's a significant upward revision compared to our previous estimate, which was 2.4%. Of course, if the outturn is worse than our baseline, then obviously that default rate is going to rise. But that's basically the big picture view and our view over the economic outlook and also how that's going to impact default. So Mark, back to you.
Right. Okay. Thank you very much, Michael. Maybe at this time, I would go over to Richard to see whether you've got any comments on Michael's views on the economic outlook plus the defaults.
No,
Richard?
I mean, I think the key issue is the difficulty in looking into the future, given that this has been such an enormous shock, both economically and medically. And it's very unclear as to where we are going to be going forward. We don't know the extent even of the sell-off in the economies, never mind the extent of the rebound. I tend to be of the view it's going to be an L-shaped recovery. I think Mike said it very well in terms of 2021 growth targets and likelihoods. I guess the vaccine will be the big swing factor in terms of determining how extended this economic downturn really is, and which countries will get affected the most. And that's the thing, it's a global crisis, this one. So it's very hard to ascertain all the effects that we're going to see between, originally it was just China, then it was Asia, now it's global, re-affecting China from a demand perspective. So it's very hard to model all those points, but I remain relatively negative. And in terms of pickup in defaults, I think it's just natural in terms of the economy. Now, whether we see it in the traditional bond market or the loan market, that might be a bit more of a different question to answer.
Okay, great, and I think we'll pick up on that a little bit later. And maybe Cecilia, over to you. I mean, do you agree with this, that we're looking at an L-shaped recovery? And over to you.
Yeah. Put it this way, I won't say I disagree, but we kind of have slightly different perspectives there. In terms of shape of recovery, our central view here will be U-shaped recovery. It's not L-shaped. That means the recovery will come in and it's not like just flat in the foreseeable future. And also we agree that, say, when the growth is stabilized, it will stabilize, the GDP will stabilize more at a level lower before the at the level lower than that of before the virus crisis there. So we are not too different. I mean, we all know that it all depends on how the vaccine, how things develop, and how long the global lockdowns will be. But the consensus is, I think one thing important is what is the market have priced in right now. I think the market have more price in a U-shaped type of, I mean, not a V-shape, but recovery will come in the foreseeable future. And then in terms of the default rate there, we are slightly more optimistic as compared with what had been mentioned earlier. For the 6 points, we have done some bottom-up analysis in our research team as well. 6% is kind of our worst case scenario, but for our central case scenario, our expectation is closer to 4% rather than 6%. So so we are quite similar trend, but slightly different in terms of the level and also default rate expectation.
Yeah, great. Thanks, Cecilia. And I think we all wish to be in your backdrop there in Sydney. It looks quite beautiful compared to this rainy Hong Kong where we are. But maybe Michael, back to you, and maybe we can switch a little bit to the credit quality. What do you see? How's this impacting the credit quality in China, India, more broadly in the ASEAN and the sovereign corporate bonds? And there is a quick question here from somebody asking, can you please confirm whether the default rate you mentioned at the beginning will rise by 6.4% or it will be 6.4%? Thanks.
It will be 6.4%, or at least that is our forecast. I mean, I wouldn't say it will be 6.4%. Our forecast is that it will rise to 6.4%. By 6.4%. Yeah, I mean, just turning to credits in the region more specifically, you mentioned China and India. I mean, China, we have an A1 stable rating. That indicates that we don't see at the moment any downward pressure on China's ratings. And I think it does raise an interesting point about the purpose of ratings and what we're trying to do. We've been trying to take a fairly measured approach towards our ratings management during this period, because obviously the intention behind ratings is that they're intended as an ordinal measure. So you need to have some highly rated companies, corporates, countries as an anchor for the rest. So there is really no point in moving all the ratings down in lockstep. And we've tried to avoid doing that. So, I mean, there are countries where we don't see major downward pressure at the moment, and I think China is probably one of those. Certainly, there are a number of factors that we've taken into account in our current rating, including we were expecting growth to trend downwards over a number of years. Obviously, the decline in the growth rate in China has been more substantial than we were expecting, but we're trying to look through the cycle with a lot of these credits as well, so that we're trying to look through the immediate economic shock to where things are going to stand on the other side of that. The degree of fiscal stimulus that Chinese governments provided has been relatively modest compared to some other countries. So again, we're not expecting to see a huge blowout in terms of debt levels. Although, of course, a lot of the support that has come in China has not been direct government support, but has been through various indirect forms, such as through the banking system. India is a slightly more interesting case. I mean, we have a Baa2 rating for India sovereign with a negative outlook. And that negative outlook reflected a couple of factors. One is that the growth rate is slowing down and has been slowing down. And the extensive lockdowns that have been announced in India and been applied there for the last month or so, they have had a major impact in terms of consumption. And that has pushed the growth rate down further. So we're expecting negative growth in India this year. And also, I think the other issue with India is in terms of the financial system, which has been under a bit of strain for the last 2 years. I mean, first with the problems in the non-bank financial institutions, starting with IL&FS back in August 2018. But you know, since then, the problems have spread a bit more widely. Quite a number of the MBFIs are essentially now aiming to protect liquidity rather than to extend credit. And of course, there have been emerging problems in the banking system itself, directly in the banking system, such as around Yes Bank. So there are a number of pressures there. As far as the rest of Asia is concerned, it's a bit more of a mixed picture. There are a number of economies in the region which were beneficiaries from the US-China trade dispute. We saw some relocation of supply chains. That helped countries like Malaysia, Thailand, Vietnam particularly. On the other hand, the impact of coronavirus has been pretty widespread for those countries which are exposed to China in terms of supply chains. As major suppliers to China, there's been a negative impact. And for most of the countries in the region, exports are still a major source of demand for countries in the region. So the kind of disruption that we've seen to global trade recently is clearly a negative. Finally, just talking about specific sectors which are impacted, I think the immediate impact has been on sectors like aviation, tourism, hotels, gaming, gambling, and so on, where we've seen an immediate impact. There's also been some impact on commodities. That has obviously had an impact for some commodities producers in the region. But as I mentioned earlier, we're trying to take a measured approach towards ratings here. So we're trying to avoid going for wholesale downgrades. We are trying to identify those sectors that are most impacted and taking rating action appropriately.
Okay, thanks, Michael. Maybe just two quick questions for you that have come in. I mean, one you've pretty much have answered in a slightly different way, but the question is, for the 6.4%, where are you expecting this to be broken down by countries? And I think you've kind of given a sense of that. And then the other one is, with all the central bank accommodative policies, you guys still seem to think there'll be a fairly big spike up to 6% levels. You're interested in your thoughts on that?
Yeah, I mean, for the first question, there is a report that we put out about 2 or 3 weeks ago, which gives us more detail. I mean, that 6.4% is for high yield corporates across APAC. It's across the whole of the APAC region. In terms of breakdowns, yes, I mean, obviously there'll be some variation across across countries there. And of course, the high yield portfolio, rated portfolio, I mean, we have a greater concentration in some countries than in others. As far as the monetary policy response is concerned, I mean, that's quite an interesting one. I mean, I think the indications are, and what I'm hearing from the market, are that the extensive liquidity provision that the Fed has provided has not really flowed back into the region in any substantial way. So we're not really seeing a lot of impact from Fed easing coming back into the region. There has been a bit of an increase in yield spreads again for Asian issuers. I think that's fairly consistent with the big picture that we're seeing in terms of capital flows to emerging markets generally, where we've seen some reversal of capital flows during the coronavirus period. Central banks in the region are in a position to provide some degree of support to the domestic economies, though. I mean, you know, obviously this affects maybe credit quality more directly, and also local currency markets rather than the US dollar market. But central banks are in a position in the region to provide a bit more policy easing. They're not quite as constrained in terms of policy space as some of the other major central banks are, like the ECB and the Fed. So they do still have a bit of space to ease interest rates further, and that should help both in terms of economic growth, but I think also in terms of local currency markets.
Great, thanks, Michael. Maybe Cecilia, over to you. Michael's kind of view at Moody's is that the Chinese market's fairly positive, India a bit more negative, the rest of the region a bit more mixed, but there's still a lot of room in this part of the world for central banks to help out in terms of monetary policy. I mean, what are your thoughts on the credit quality here? I think you're on mute, Cecilia.
Yeah, we largely agree. And also, when we look at the big picture, what Michael has laid down earlier, we are in line with that type of thinking. But in terms of a portfolio management approach, when we look at the credit management, what we focus will be identifying the falling angels or a company that have liquidity problems. Like, of course, no one would like to have anything that hold to default. So how avoidable are those defaults? One thing that our central view is like, yeah, the average credit rating is in a declining trend. I think there will be, in general, the average credit rating in the market will drop in Asia, also globally. So the downgrade trend will continue, and also the number of fallen angel will increase as well. So it's something that we have to be cautious about. And then we mentioned about the probability of default earlier, that has to expect to increase, etc. One thing about the COVID-19 is because it's such a global and macro crisis, and so as Michael had mentioned, like there will be government support, their monetary support, and also the fiscal support will be very important. And also, if you look at the, compare with before the crisis time, I think the strength or the amount of government support will be even stronger now, because in order to avoid any systematic default situation. So I think that is important, because that will help with the liquidity of the corporate and also the sovereign as a whole. And also the market or investor side generally will be more receptive on a lower credit rating investment. So that is something useful in terms of providing liquidity to the market. When the system there has ample liquidity or sufficient liquidity, that will reduce the number of defaults or will help how the corporate balance sheet, help out the corporate liquidity situation accordingly. So I think in terms of China and India, we agree that for China, again, if you look at the latest number of default, in fact, the it hasn't been like jumped up because of the COVID virus, etc. Again, it's thanks to the support from the government side and also the the liquidity, the ample liquidity there. And then for India, we have more concern about like potential number of falling angel and some selective default. But luckily, again, we don't expect systematic risk in the system there. So I think that is the key thing that when we analyze those companies, and that is to avoid the fallen angel and the company that have liquidity problem.
Okay, thanks, Cecilia, and for giving your thoughts on that. I mean, maybe Richard, over to you on the credit quality, and also maybe there's a question that came into you around how the green bonds are faring in the crisis, and do you see evidence of outperformance? Is the primary market pipeline? How's the primary market pipeline looking as well? So maybe you can answer that and when you give your thoughts around the credit quality of China, India, ASEAN.
Okay, so on the credit quality side, I think the one thing to add to Mike that was important was the Fed lines extended to things like Bank of Korea, et cetera. So that massively normalized things like cross-currency swaps. And I think that really did take some of the systemic risk that was seen in the markets, in Asia at least, somewhat off the table. And some of the stresses in the local markets were definitely reduced by that. Now, of course, that doesn't extend to many of the central banks in Asia, but it does help reduce some of the systemic risk. When you look at default risk, clearly, particularly when you talk about high yield, the vast majority comes from Southeast Asia, India, or China. And in China property is a big factor there. So ultimately, your view on defaults is a view on the China property market in some instances on a macro basis. And there we have relatively benign views. We think it will be one of the supported by the central government in order to ensure that it's a pillar of growth within China. That doesn't mean there won't be defaults amongst weaker property developers, clearly, but we don't, as an organization or in a credit trading business, we don't see that as a systemic risk in terms of the high yield market in Asia. So overall, in that perspective, in terms of the question on green bonds, the data in Asia is very hard to come by given the supply, but from what we can see globally, there has been an outperformance of green bonds versus the traditional bonds. And that's primarily, in my opinion, because they tend to be more tightly held by green investors who didn't have the same concerns on redemptions that maybe other funds had. So there wasn't quite the need to sell. The data's spotty because the trading volumes are actually somewhat spotty. And in the worst of the crisis, it was very hard to see where prices were, even in the most developed of markets on the credit space. But it does seem that they are lower beta instruments, which is not really surprising. In terms of the pipeline, it's an interesting one. I mean, I'm aware of at least 3 transactions in the region that were penciled in to be sustainable deals that actually came as traditional bonds. Primarily just given the extra time and education that's required in doing things such as roadshows. The roadshows tend to be more extensive when you're dealing with green or sustainable transition bonds. So in order for companies or countries who needed to raise financing quickly, they actually reverted to the straight bond market. Having said that, at least globally, there's of course been a massive boom in COVID-19 related issuance. We've seen some of that in Asia, but to a much lesser extent. Mainly from the financial side, a few private placements in the corporate side. But I would expect as things normalize again, that we do see the green market re-emerging as a substitute stroke area for growth again, and certainly within what BNP expects, it will normalize again in terms of supply and continue to grow. But it has actually taken a bit of a setback in terms of supply in the last 6 months.
Good. Thanks, Richard, for that. Maybe staying with you and now turning a bit from, we talked about credit quality, the primary markets, and maybe looking now more on the impact on the liquidity in the local currency markets versus the US dollar market. So, what is your view on the, that difference between the hard currency and the local currency markets? How do you think that's been playing out on the liquidity side at present, and how have some of the programs that we've mentioned in the U.S. been supporting those markets or impacting liquidity available in the investment grade or high yield credit?
Yeah, so clearly, I mean, the fundamental issue from a financial perspective back in March was this dash for cash. Everybody was just running for cash. We're all very aware of it. And clearly that had an effect in every market. I mean, when you saw distortions in the US Treasury market, it's likely you're going to see distortions in Asian credit, being one of the less liquid markets around, and as well as the local rates markets. I would argue that in terms of the rates markets in particular, though it's not my area of expertise, they held in pretty well over this whole cycle. And we've seen a rebound, particularly in the FX markets, from severe stress, which is also helping the credit markets, particularly for the sovereign issuers. So I would say overall, it was the market held in relatively well. Of course, it's hard to say because everything was impacted and is still impacted from work from home. So particularly in Southeast Asia and India, we still have work from home. I mean, things are normalizing here in Hong Kong, as we all know, but and in China and else in North Asia to a degree, but in Southeast Asia and India, there's still a lot of work from homes. So some of the liquidity is being evaporated. And then also the need to do transactions. There was a lot of need to do transactions in March and April. That's actually slightly less now. So we're actually seeing volumes come down. But overall, I would say, the local markets on the government bond side acted fairly well. In terms of the local credit markets, there are only really two of significance. I mean, no disrespect, the two that we follow at least are China and India. China is an interesting one because China is actually slightly ahead of the cycle. So you had a situation in China where basically the COVID hit in January, and then we saw an impact on financial markets, nothing like as much as happened a few months later in the rest of the world. So the shutdown happened much earlier in China. And the credit markets, particularly the dollar credit markets, continued to operate. And that's when the PBOC started pumping in lots of liquidity. So what was an interesting phenomenon was when the real sell-off happened in the global markets, China onshore market was actually open for business, and people were able to finance in the onshore markets in China. And actually supply picked up massively. And then on the front end, we saw massive liquidity and basically front end MTN rates have rallied 200 basis points from where they were. So there's plenty of liquidity available onshore in China and a massive steepening in curves because of the supply in the long end. That doesn't mean that there's a lot of, that all private enterprises are able to borrow onshore in China. So it's not a panacea in that sense, but it definitely allowed to control some of the sell-off. India is the other big market. And for me, that's a very bifurcated market. You have, for many of the reasons Mike outlined earlier, effectively the very high quality corporates can borrow money either through the banks or through the financial system there. But I think the market is pretty much closed, at least for now. Maybe it's reopening with some of the RBI comments recently, to the weaker credits. So we've got this bifurcated market, and it hasn't clearly been helped by the fact that some notable asset managers have put up their gates, put slow redemptions in India because of the lack of liquidity in the underlying credit markets and all the liquidity of the underlying corporates that they've purchased bonds from. So there have clearly been some issues in specific markets like India. We haven't seen anything like to the same extent in China. That's on the local side. On the hard currency side, it's been a very interesting dynamic. So clearly, there was a massive liquidation in March when concerns about how global COVID was. And it was really led from what happened in the US in particular. We saw a significant amount of deleveraging, particularly from private banks. Private banks and private bank individuals tend to take on quite a lot of leverage when buying bonds and other products, and they had to delever. We also had asset managers who were either getting but more likely concerned about redemptions and therefore trying to build up their cash values. And globally, we saw basically an inversion of credit curves. So everyone was just trying to sell what they could, particularly in the front end. And with the Fed stepping in and the ECB and effectively backstopping the market, that backstopped the US, and that definitely helped backstop, without the Fed actually buying Asian paper, what was going on in Asia. And so since then, the market has been a very interesting one because we stabilized, we started to rally, we stabilized again. And again, particularly in the last week, we've had a significant rally in investment grade and emerging market credit. And I think that's really driven by, I think, sort of similar to one of the questions earlier. We have a zero interest rate policy in much of the world. People are much less worried, particularly on investment grade credit and high quality emerging market sovereigns, that they will not get they will get their money back, and therefore are just looking for places to park money. We're seeing inflows into emerging markets. We're seeing inflows into ETFs, both that follow investment grade and high yield, particularly because the Fed is buying those products. And so we're benefiting second order in Asia from all of these effects. Plus, as I mentioned earlier, the swap lines for certain countries have definitely normalized some of those markets. And I think one big driver that's very different in Asia that's worth highlighting is supply. So if you look at the dollar bond market, in the US, supply year on year, I think it's a good analysis, is up 94%. And a lot happened in March, carried on happening in April. Why? Because corporates drew down on these lines they had with the banks. And then as soon as the market opened, slightly on the back of the Fed, they decided to come in and refinance in the bond market. We saw something similar to a lesser extent in Europe. You think European spreads were 40% higher year on year. Even the US high yield market supply is 13% higher year on year. In Asia, March was effectively closed for dollar issuance and euro issuance in Asia. We had a rebound somewhat in April and continuing in May. But even year to date, we're still 7% lower than we were a year ago. And there's a few reasons for that in my mind. One is in the high yield sector, particularly in China property. In January and February, we saw massive issuance, so a lot of pre-funding. So the Chinese property companies in particular did not need to come to the market at the worst. As mentioned, the onshore market, particularly in China, was open. So high quality corporates could borrow onshore quite easily and finance themselves there. And I think the banking market has actually stepped up, and certainly what we've seen, to provide liquidity, again, certainly to high quality corporates in the banking sector. So unlike 2008, we're not seeing this massive sell-off. So overall, I think that's helped the supply-demand dynamics clearly, because it's very clear that the demand, the supply side in Asia has nothing been as great as we've seen in US and Europe. So this search for yield has definitely driven spreads tighter.
Okay, great. Thanks, Richard. And maybe to my team, well, I'm going to direct the next question to Cecilia, but maybe we can put the poll up. And well, I'll put that poll out to people if the team can put that one up. So here it is. You should be able to see this. You have about a minute to answer it while Cecilia talks, but where do you believe credit spreads in Asia will be at the end of the year compared to now? Substantially tighter, somewhat tighter, roughly the same, somewhat broader, substantially broader. So please answer that. Well, I turn over to Cecilia. So Cecilia, I mean, you've heard a lot from Michael and Richard, both on credit quality and as you talked about, but also on the impacting liquidity and the local currency markets and the comparison to the hard currency ones. I mean, what are your thoughts, you know, in particular around China, India, in terms of the liquidity? And also, do you think that some of the measures that the Indian government has been taking recently to support the market are helping in that regard? I think you're on mute again.
Hello?
Yep, got you.
Okay, yeah, so China, one thing, when talking about the, I think one thing that I will look at it, instead of like breaking the liquidity comment towards hard currency versus local currency, I would say it's more from the angle of the general credit quality of the issuer. Say, because what I see in China locally, in the local market there is a bigger credit pricing differentiation there. Say you look at the credit spread curve, it has deepened. That is the low credit quality bonds the yield has to trade higher compared with the better quality bonds. So that is something, a phenomenon that we have been expecting, or we think that it should happen in China rather than having a very flat credit curve. So that is happening. So it's a positive in terms of the future development of the Chinese corporate market. So that is. So when we study when we look at in China and also in India as well, I think there have been some default in some low quality bonds, and that is something that we kind of expected, and luckily it's something that we expect not to trigger into systematic risk. That is what we expected. And then in terms of the policy implemented by India, we think that is helping the local market in India to avoid the systematic risk, and so it is. We generally think that is positive there. Yeah.
Okay. Maybe I'll just show the poll now. if we look at the polling results, basically here's what I think you should see it. Effectively, it's a real mixed bag, really, and you've got somewhat tighter with 42%, but somewhat broader at 29%, and then some sort of outliers. I mean, I don't know whether any of the three of you want to comment on that. Maybe Cecilia, I'll let you comment first. I think you're on mute again. Okay. Oh, you're off now.
You mean my expectation on the credit spread? You mean my expectation on the credit spread movement?
Well, just you should be able to see the poll, I believe.
Yes.
Yeah. So, just what are your thoughts? You agree with that, or it's a bit mixed?
Yeah, yeah. I think if you show me the result again, because I can't see it on the screen, the poll result. Yeah, somewhat tighter. In fact, I also choose this one. This is also my expectation that is somewhat tighter because we can see so far the investors' interest or the liquidity demand for the Asian credit has been very good, and we have been receiving some good inflow there, and we think that the net there. Of course, we also expect more supply in the market as well, but net we think that the credit spread will tighten from here, not in a big way, because of the more supply coming into the market as well.
And Richard, any comments from yourself on that, or Michael, on the poll?
Yeah, I mean, I tend to agree with Cecilia. I'm also of the view that this low interest rate policy is just going to keep people coming into the Asian credit markets generally. I still think we'll see a great differentiation between credits. I mean, we still have a number of high yield credit trading below 70 cents, clearly, because it's very uncertain as to their ability in the medium or long term or even short term to pay off. And the one thing I think is mentioned in one of the questions about what happens if this if the coronavirus is significantly worse and we don't have a virus. Yes, I mean, does the Fed have a lot of room to play? It has a few more tricks up its bag. It clearly doesn't want to go to negative rates, but it might be forced to, I guess. And we could see a significant retracement in equity markets. And again, what real worries about default rates really picking up and another Great Depression, all of which would have a negative impact. It's not my personal base case, but yeah, there is a risk. There is a real genuine tail risk that this thing gets a lot worse again. But I think the general view will be we will live with this. It will cause changes in the way we live and the changes in the economy, but interest rates are low and people need to put money to work and want income, and they will put it in what they view as being safe quality bonds.
Great. Okay. Thanks, Richard, and thanks to the 150 people who voted. So maybe Mike, over to you, and you can comment on this, but also maybe looking ahead at the outlook of the defaults over the next 12 to 18 months. And also, there's been a few other questions. I mean, Richard picked up on the one about if this gets a lot worse going forward, what is your view on that and the Fed's ability to have room to maneuver? And also, maybe there's another question about your timeline on revised rating announcements for India. So over to you.
All right. Well, I'll take the last one first because that's the easiest. As I mentioned earlier, we have a Baa2 rating for the Indian sovereign with a negative outlook. We assigned that negative outlook, I think it was November last year, so about 6 months ago, let's say. It normally takes us about 12 to 18 months to resolve a negative outlook. That's on average. Sometimes it's a bit earlier than that. Sometimes it takes us a bit longer than that. So that's the kind of timeline that we're looking at. I think in terms of the other part of your question, I mean, I'm looking at the replies to the poll. I think the dispersion of replies indicates just how difficult it is to forecast at the moment. And, there are so many unknowns in this sort of situation. We could be, as Richard was saying, looking on a worst case scenario, looking at something a sort of Great Depression like. Alternatively, if a vaccine is found which is effective and which can be rolled out relatively quickly, then things could turn around, although I definitely wouldn't expect a V-shaped recovery in that sort of situation. I've recently taken to sort of describing the coronavirus outbreak as not being like a typhoon. It's more like an earthquake. You know, with a typhoon, you sort of hunker down. The typhoon passes through, it does some damage, you repair the damage afterwards, and then life goes more or less back to normal. I think with what we're looking at with the coronavirus is it's more like an earthquake, particularly a severe earthquake, because after an earthquake, there's often a lot of reconstruction to do. You can't often reconstruct on the old pattern. You have to introduce new building codes. Some of the ground's too unstable to rebuild on. So things change pretty fundamentally. And I think, you know, we are in an environment where we are looking over the medium to longer term. So a slightly longer horizon than we tend to look at from the point of view of our credit ratings. But if we look at a sort of medium to longer term, 5 years or so, I think we are looking at a fundamentally different environment. And one of the features of that environment, one of them, I think, is going to be lower long-term potential growth. The impact of the coronavirus outbreak is in some ways analogous to the kind of impact that you get from a financial crisis. There's a lot of academic studies that have been done that show that if you have a financial crisis, long-term potential growth suffers as a result, and you know, countries find it hard to recover to the old growth path. I think we might see something similar as a result of coronavirus. And one of the consequences of that is that we are going to be looking at what we've been describing as a house as lower for longer interest rates, but I think they're going to be lower for longer and longer and longer. I mean, we are looking at a situation where it's going to be very difficult for central banks to reverse these extraordinary monetary policy measures that they've taken anytime soon. So I think this low interest rate environment is going to remain with us for a long time. And as, again, to go back to a point Richard raised, you know, that does mean that there will be some hunt for yield.
Okay, thanks, Michael. I mean, Cecilia, maybe over to you on your thoughts on this. And there's a couple of questions that have come in sort of related. I mean, one is that on one hand, the panel's view is of tighter spreads down the road, yet there's an anticipation of defaults. What am I missing here? If risk perception still persists amongst investors, why would they take risk? And then another one, you know, reading the press, inventory levels are up. We might be facing a consumer demand crisis. Are you taking that into account to your fairly bullish views? It seems that those out in the audience are thinking we're pretty bullish on the market. So wouldn't mind getting your thoughts on that.
Yeah, I think it comes to a question about whether you expect those defaults can be avoided. I think if you expect the default rate, I mean, like, if those default potential issuer that is avoidable, or you've got the capability to avoid it, then you have reasons to be more positive. Because if it's already priced in some issue that they're going to default, and it is like can be anticipated by the market, by investors, then it makes sense to stay bullish. The reason why I feel more relatively optimistic is because we have been seeing very good investor demand for Asian credit bonds. Say, well, maybe back to the default rate first. In terms of relative value, we do expect Asia to have better relative value, even fundamentally compared with the rest of the world. Compared with the EM general, say, from a bottom-up analysis. Say for Asia, we expect the default rate to be 4%, as what I mentioned earlier. And then for EM as a whole, we expect more than 5% return, 5% default rate. And then for US high yield, expect it to be close to 8%. So in terms of the default rate expectation, we expect Asia to outperform in the first place. And also, we expect that fundamentally, Asia will come out as fundamentally stronger or better compared with the rest of the world. So with relative value, expect more overseas foreign investors to come to the Asian credit market. And also, we have a stronger demand from Chinese investors as well for diversification. So with strong demand, sometimes it's also chicken and egg. When you have good demand in the or ample liquidity, investor liquidity, then it will help the company, the corporate, to refinance. and help them to resolve the liquidity problem. When their liquidity problem is resolved, that helps us to reduce the opportunity of getting, say, default or some liquidity problem. So it's self-fulfilling in a sense. So I think from that aspect, where that explains why I'm relatively optimistic. Of course, but that is under expectation that we expect V-shaped recovery, vaccine will come in coming years, etc. Like, yeah, so that, and also with the fact that we don't expect a systematic default, that is important, yeah.
Yeah, thanks, Cecilia. I mean, anything more you want to say in the sort of the last discussion point on the emerging market credit landscape differing going forward from those of developed economies? I mean, you've kind of given some thoughts on that already to a certain extent, but anything more you want to add?
Yeah, I think the one thing is the I think that also I touched this point earlier as well, is the general credit rating of the market and also the investor expectation. I remember that in the old days, maybe back to 10 years, 20 years ago, people's expectation on their investment grade was for A. But now people move to, say, triple B, and also like the average credit rating of the market have reduced, and also investor also be more receptive to lower credit rating as well. That is a trend that is important to be supportive for the credit market as well, because that means there could be more smaller company or some some good company. They may not be in a very big scale, but they're able to finance and get the bond market more active. And so that is one point that will be supportive for the development of the credit market in this region, and also the general. I think general investor appetite on credit bonds as well. I think we also see more shifting from the equity investor into bond investment as well. So credit bonds is again like in terms of risk reward, it does offer some very good some balance, more balanced risk reward, and also with the interest rate continue to be at a low very low interest rate or deposit rate environment. So it's again positive on the bond market as well. So ultimately, of course, we have to need to do our homework well to have the good bottom-up credit research support there as well. Yeah, that's the key.
Thanks, Cecilia. I mean, maybe we'll just put up the second polling question and the last one now. Here it is. Considering everything you have heard, what will you be the most overweight in by the end of the year? Sovereign bonds, investment grade, high yield, local currency credit, or just cash? So start voting now. And I'll hand over now to Richard to kind of give his view basically on the emerging credit landscape. But there's also a couple of specific questions here for you, Richard. I mean, one is, and you kind of touched on this already, do you think that the strong supply in China bond markets were primarily driven due to upcoming redemption in the US markets as these issuers are finding it difficult to refinance in the US dollar markets? As I said, you've touched on that already. And then this other question is interesting. Since allocation in the emerging market in fixed income ETFs and funds in the pre-crisis period, do you see a possible contagion trade exacerbating the situation beyond the actual pandemic risks?
Okay, so starting with that one, I think we already saw it. So in March, we clearly saw financial markets react more negatively. I mean, you can just debate equities, but other financial markets react more negatively than was probably purely from the risks of the virus specifically, right? And that's already happened. The question is, does it happen again? And my personal view is we've seen the worst when it comes to that sort of liquidity crisis, right? That's not to say if we don't have a second wave, we won't see wider spreads or lower equities, but I don't think we will see the same sort of velocity and volatility that we saw previously, which is another reason for the slightly bullish view, particularly on investment grade credit spreads. Is to me, investment grade credit on aggregate is effectively a short volatility trade, and I think in essence we'll see volatility. It will pick up, it will ebb and flow, but I think those extreme volatility has gone. And so if you don't have those systemic risks, then on aggregate in a zero interest rate world, investment grade credit looks good. Someone asked about valuation. I mean, is it contrary to be bullish and then have default pickups? Like everything, it depends on valuations. And I think it's also very important to distinguish which sectors that you're talking about, right? I think the pickup in my personal view, the pickup in defaults is largely a high yield phenomenon. It won't be much of an IG phenomenon. There may be a few fallen angels along the way, as Cecilia says, but certainly in the near term, I think defaults will be very much a high yield phenomenon. And then you have to ask whether it's already in the price. And that's on bond by bond basis. On an aggregate basis, you are probably paid, certainly based off Cecilia's predictions, for the risk based off the default rate that we're now currently seeing in terms of spreads. But is it going to be coming down to picking on individual credits? That's definitely going to be, and always is the case when it comes to credit. Although you could have argued that in March it was just a long or a short. But now we've stabilized, and it's really coming down to deciding, you know, which sectors you want to be in, which individual names you want to be in. And in Asia, slightly different. You know, take China. China is the biggest part of our market, 60+%. It's dominated by SOEs. It's dominated by, in terms of supply, it's dominated by banks. It's dominated by local government financing vehicles. And in the high yield sector, it's dominated by China property. So it depends on your views on those individual sectors, really determines 50% or 40% of your aggregate view on Asian credit when it really comes down to it, on an aggregate basis.
Great. Thanks for that, Richard. And Michael, I'm going to give you over to the last word, but I'm just going to show the polling results right now. And so basically, if we look at this, people are saying investment grade by a fairly significant margin. And then you've got probably three equal between sovereign bonds, high yield, and cash with local currency credit coming up the rear. I mean, your thoughts on that, and also, you know, one last thing. I mean, there was the question around Hong Kong that came in, and you know, what your view is on the rating and GDP growth on Hong Kong given the recent geopolitical instability. I'll leave the harder one to the end.
Yes, thanks for that. Really appreciate asking those questions. Yeah, I mean, on the polling, I mean, I don't really have a lot to, I mean, just to Richard's point about expecting the defaults in spec grade, not IG, I hope that's going to be the case, because that would suggest that we are doing our jobs in the credit rating agencies, and you know, we're trying to avoid having defaults in investment grade, and you know, if we're doing our jobs properly, we shouldn't have any. So that's really what I would hope to and expect to see as well. Just coming to Hong Kong, I had a feeling someone was going to raise a question about Hong Kong. I mean, as far as the economy is concerned, I mean, you know, Hong Kong's economy has had many ups and downs over the years, and I mean, one of the features of Hong Kong's economy is its volatility. And in line with something I said earlier about the way in which we try to look through the cycle with our ratings, I think short-term volatility in Hong Kong's economy is not something which would really weigh heavily in terms of our ratings. What does weigh heavily, and where we have identified potential downside risks for Hong Kong's rating, are institutions, and also the possibility that geopolitical factors could weigh on Hong Kong's longer term outlook. You know, I think it's also important to remember when you look at that Hong Kong is unusual in terms of our overall portfolio of ratings. It is very unusual to have somewhere which is essentially an administrative subsection of a larger political unit with a higher rating than the larger political unit. There are very few precedents for that elsewhere in the world. I think maybe some of the Italian regions have a higher rating than the Italian sovereign by one notch, but it's very unusual. So, you know, to justify that ratings gap, because Hong Kong is AA3 stable, China is A1 stable, so we've got a one-notch rating gap. To justify there has to be some differentiation in terms of institutions. And as we flagged in our commentary and our most recent credit opinion on Hong Kong, if we were to see further convergence in terms of institutions between Hong Kong and China, then that would obviously have implications in terms of the rating. So I think that's you know, basically where our view currently stands.
Thanks, Michael. Unfortunately, time's up, and I'd like to thank everybody for joining. And we've kept well over 300 participants on the line the whole time, so thank you very much. Thanks for your questions. We tried to answer as many as we possibly could, but there's been a few we couldn't get to. But so again, thank you for your participation in the polls. And I'm going to hand over to, and I wanted to thank the panelists, obviously, Michael, Richard, and Cecilia, for your frank and honest assessments of the credit market here, which generally speaking are fairly bullish at the moment. But obviously there are some still worrying concerns around the virus and how that will play out going forward. So I'll hand back over to Millie to wrap up.
Thank you very much for joining us today. Our next virtual event will be on Thursday, May 28th. A very timely topic, COVID-19, navigating the new normal for the financial industry. This is again a free event, so please reserve your seat by either scanning this QR code on the screen or visiting our website, www.asifma.org/events. We hope to see you there. Thank you very much and have a good day.